All right, so what happens if Karen and Ken suspend Social Security, but this time we're going to add what happens if they also start converting to Roth IRAs immediately. All right, so that's the part four of our scenario on Ken or Karen and Ken. They have 150,000 in IRA. They get about 47,000 a year in Social Security. We have them both at 67, and Karen gets a small pension of about 13,000 a year. So let's see how this works. So dive right into this by subscribing down below. As always, thumbs up, comments, hit the little bell for notification for future videos because we do a lot of videos here at Heritage Wealth Planning YouTube channel. And then, of course, always share the content if you like it and you think others could find value here. So let's dive into this. And first thing we got to do is go make sure that we have Ken dying at 90 instead of 80. Let's just make sure there. And then we'll kill Ken off at 90 again. Okay, 90, good. At 80 again, excuse me. Very chivalrous here at Heritage Wealth Planning. Let's just make sure we have Karen dying at 92. Okay, good. All right, so let's go to what do we want to do here? Let me just okay. We want to go to Roth IRAs. That's what we want to do. So we want to go to income. They get $150,000 in IRAs. We'll have Karen. We'll just say she's converting $20,000 a year, and she was doing it right out of the gate until basically her account is exhausted. So that should be for about 5 or 6 years or so. And the reason for that is because they're taking money from the IRA on top of doing the Roth conversions in order to pay the bills. And then we'll try right out of the gate, and then we'll try waiting a couple years. There's a method of my madness here. Okay, so everything else stays the same. They're going to suspend Social Security until they're 70. Yeah, okay. They're going to start doing Roth conversions right out the gate. All right, good. Let's see what we're looking at here. So from a tax perspective, let's see what we got. And here they got, they're up in the 7.3% effective tax rate, and that drops to basically nothing. And then why do we got that? Oh, yeah, 1.3. That's not much. All right, so it's still okay. From an arithmetic, not a logarithm, but arithmetic, that's still under 10%. So it looks like as big as not because there's still 8% there, 6% there. So they're paying 5.2 to the feds there and 2.8 to the state. But why are they even paying that? So let's go to cash flows. And let's see what we got here. Let's go to accounts. Yeah, there's a Roth 20,000. They run out of, then there's no more Roth. There's no more traditional IRA at that point. So let's go to ending balance by accounts. Traditional IRA is gone. The conversion to the Roth, there you go. It stops, and then they have this because they're deferring Social Security. They have excess money being put in their taxable account, pretty significantly actually. So let me go to cash flows here. 13,300. So they have to tap into that. That money right there is going to come from their IRA. Plus, when I tell you about plus the Roth conversion. So I'll show you what I'm talking about. So we go to ending balance by accounts. So let's go withdrawals from accounts. So there's their traditional IRA, which consists of 44,000 that they got to use for cash flow plus 20,000 Roth conversion. All right, that's good. So now if we go to taxes here, the first couple years is $5,600 in taxes, 5,800. And it slowly goes less and less, and then their federal taxes start going down. Now they start paying more at 2034. Why is that? So let's go to taxes in 2034. Is that because they're having pretty significant qualified dividends and interest in long-term capital gains? Let's see. So we're going to go to 2034. Well, here's 2020, 77,000. That's their pension plus all the money they're taking out from their IRA in which to convert and which to spend. And as you can see, $27,000 of standard deduction. So their taxable income is $50,000, basically at 10% for the first $20,000 and 12% for the next $30,000. $5,600 is their taxes. Now, if we fast forward to 2024, just watch this. Significant Social Security is $67,000, of which only $10,000 is taxable. That's their pension right there, $15,000 adjusted each year for inflation. This is their standard deduction at $29,000. So their standard deduction is above their taxable income, so they pay no tax. And that's good. There's going to be a method to our madness. Why we're going to use that later. All right, 2034. Well, they got tax. They got interest a little bit, qualified dividends a little bit. Nothing much there. Pension annuity, and they got to pay a little bit on Social Security. So they're total. So we got they got $86,000 of Social Security, $20,000 in pension, about $10,000 of taxable interest, and a qualified / ordinary dividends. And they got 21,000 for standard deduction. 11,000 will be the personal exemptions. Again, it doesn't read that here, but it is personal exemptions, not QBI. $29,000 in total taxable income and $2,100 in taxes. That's not so bad. But basically, it's their pension. Their pension is going to make some of their Social Security taxable. And there's no getting around that. I mean, there's just no getting around that. Still, that's not so bad, though, man. I mean, look at this. We're talking. Oh, actually, let's go. Let's go to cash flow, and we are talking from a tax perspective. Hardly anything. Oh, sorry, guys. Let's go here and look at that. We're talking $6,000, 4,000. I mean, that's just nothing. So let's go to summary cash flows, and we're gonna go to tax payments, and we're gonna put this in our trusty old Google Sheets. Scroll down here. Let's cut and paste that. And this is Roth conversions immediately with Social Security delay. Okay. So let's tally up this total tax payments that they have. It's not going to be much. All right, some. We're going to go up here. Yeah, $79,000 in total taxes. That's what I'm talking about. All right, so we go over here. The total income $2.189 million and $79,000 in taxes. Can't beat that. Let's go to net worth, so we can look at net worth of the same thing. And let's see what we got. 1.92 million. That includes a home. All right, that does include a home. And I mean, I'm throwing out a home at 2% appreciation. But I mean, so all right, let's look at this with a Roth IRA right out of the gate at $20,000 a pop to convert to the Roth. Plus, they're deferring Social Security. Did I not paste it? Oops, that's not gonna work. Plus, they're deferring Social Security until they're 70. Oh, hold on just a second, my friends. For some reason, you can't have the whole thing. It doesn't matter. Yapping here, so. There we go. And so their total net worth here is $1.921 million. And they paid $80,000 in taxes, $2.189 million in total income. And here they had a net worth of $1.839 million. And here's $1.91 million. And this is without doing the Roth IRAs. And I think that's with is that with Ken dying early? I think so. Ken dies at 90. No. So here you got Ken dying at 90, no Roth IRAs. They have net worth of $1.893 million. Here Ken dies late, dies at 90 with Roth IRAs. They get net worth of $1.9 million. And then when they were doing the Roth, they had $2.189 million of income and only $79,000 in taxes. And I'll wrap this up in a final video. That's nuts. All right. So anyway, let's keep going here. I'll wrap all this up. I know it's not making a whole lot of sense for you here. What am I missing? All right. So that's what I want to do. Oh, we want to kill off Ken early. So let's say we kill off Ken early, and we're going to kill off Ken when he's 80. All right. Boink. And that's going to make a big difference, I'm thinking, because at that stage, they don't have our IRA mandatory distributions. And let's take a look at tax. Yeah, well, look at that. Why is that so high? It's got because they lose the standard deduction. Yeah, she loses Social Security. Half her Social Security's taxes. She has her taxable amount is 13,000. That's her pension right there. And she only gets a one standard deduction and one personal exemption. So she has, she just, man, that just bothers me. Like, I can't explain. So let's go to cash flows. So the income flows, again, they're doing Roth conversions. So they're not taking anything other than from their IRAs, their taxes, similar to it was last time, just because they're still married filing jointly. Now we're at 80 years old. We got $101,000 of income, 73,000 expenses, tax payment at $1,891. They go the very next year, they got $74,000 of income. Again, reduction of income by 25%, and their taxes go up by, that's their taxes there going up by 4,923 divided. 4,923 divided by 1,891. Again, 232%. It's nuts. It's crazy. Look at that. The right there, the proof is in the pudding, man. I know I'm saying the same thing over and over and over, but that's what, so let's save this from a cash flow perspective. All right. And we'll go over to our spreadsheets. And we'll do a tax payment right there. Now remember, this is with Roth. $120. It's just there. I cannot stress this enough. And then let's go to net worth. Oh man. All right, so let's go to net worth here. And here their net worth, they got I'm just curious how much